Hey guys, so I got you in a account that I've never shown, and that's because I don't really use it, and that's my Robinhood account. But this video is not about Robinhood. It's about being a long-term investor. Now, the stock that I have in here qualifies for that because it has dropped like a rock over the past year. And I bought 40 shares that are worth $77.60 as of today. And I'm just going to sit on it because, I'm down 50+% in this stock. And what the heck? Might as well just let it roll. And that stock is Aurora Cannabis. So I got 40 shares. Average cost of $4.86, down 60% on this one. And that's just the way it goes. But when I was thinking about making this video, I was thinking about when I first started investing was around August of 2018. And you all know that was around at that time. We had a big 20% correction. I wouldn't call it big, but we had a 20% correction in the market in December of 2018. So for someone just getting into the market and that all of a sudden happening, that kind of, it actually ends up being a good thing. But, at the time I was going through it, it was just like, scary. And that's, I think it's natural. And now we're seeing, we're having pressures here and there on this coronavirus and whatnot. And people, the new guys that are coming in are feeling that exact same way. But when I say about long-term investing, I'm going to share with you two stocks that I was invested in before that December 2018 correction. And, if I would have stuck to my guns, stuck to my research, and stuck to my thoughts, I would have, made some really good returns. So I think my point is we got to, resist fear. Trust your research if you are comfortable with what you've looked at, and buy more when you start seeing these dips, especially if you're investing in quality companies. So the first company was right here, Sony, and it was one of my first stocks that I bought, and I had bought in it. Let's see if I can find December or August 2018 here somewhere. Where are we at? Here we go. Let's see. May, June. Yeah, I remember I had entered into Sony right around, maybe it was after the correction. No, it was during the correction, because I remember I had a $47, $48, somewhere in there, average price. I only had 10 shares, but still, that was big for me at the time as starting out. So, Sony continued going down after that. And it hit a low of 42 somewhere in there. I remember that. And, about 2 months later, it hit 50. But what I was hoping for when I bought this was that Sony would come out with the PS5 in 2019. I think it was the PS5. I don't remember now, but I remember they didn't say it. They didn't announce it. And I started getting worried. It was like, okay, well, then, what's their growth going to be now? And I really didn't take a look at it because I was just focused on that one thing. So I sold out. I sold out at a small profit, but if I would have just held on to Sony and bought more, I could have gotten up to $71. So I could have rode this whole road up right here. So I was in it at 47 or so, and I could have rode that whole thing up, would have been up about, I don't know, 40, 50, 40, 45%, something like that. So that's, it's still, for as big of a company as Sony is, it's still 11.59 PE. I don't know how accurate Robinhood stats are. I've heard that they're not very, but big company, when they announce that PS5, that this thing's going to blow up, I'm pretty sure. They talk about, the death of the gaming console, but I just don't think we're there yet. Okay, so my next one is really a bummer for me. When you first get into investing, right, they always tell you to look at what look at what you're passionate about. If you're into sports, look at sports apparel, look at something that's going to keep your interest, right? Well, as you guys know, if you guys follow me for a while, I am going to retire, and I'm going to buy an RV. Me and my wife are going to hit the road and travel and see our great country. So I started looking at RV stocks, and there's two major ones. There's actually three major ones, but only two are public. There is Forest River, which Warren Buffett owns, Berkshire Hathaway owns, I should say. And there's Thor Industries, who is the biggest. And there is Winnebago. Winnebago is probably the smallest. But they are kind of family run, and I kind of connected with Winnebago, so I started looking at the whole industry. And you couldn't invest in Forest River because it was owned by Berkshire Hathaway. Well, you couldn't invest direct. So I started looking at Thor and Winnebago. Well, in my research for looking at RVs, Thor, there's two different ways to grow in the RV industry, and that's through acquisition and what's the other one? Just organic growth. Well, Thor goes out and they buy anything and everyone, and they kind of just grow by acquisition. They don't care who they're buying. They really have Thor Industries really has, among the RV owners, buyers, they have the absolute worst customer service reputation, worst quality reputation by far. So I ruled Thor out, even though they were trading pretty cheaply. I just did not like the way they run their business. Now, Winnebago, on the other hand, I liked the way they ran their business. They control a lot of their stuff in-house. They make a lot of their own parts in-house instead of just piecing together like a Lego, like how Thor and Forest River do. So when I started looking at Winnebago, they are a quality company ran by quality people. I can tell, because they don't buy. They do acquisitions, but they don't just buy anybody. Like, they bought Grand Design, which is probably one of the most modern travel trailer companies out there. They bought a boat company. I forget which one it was. I want to say it's Chris Craft off the top of my head, which is a top boat manufacturer. And they recently bought Newmar RV, which was a family-run business that had the reputation of being one of the top quality RV manufacturers out there. So I really liked Winnebago, needless to say. But if we look at a 5-year chart, back when I was looking at them, they were dipping, and I didn't know anything about it. And I think I bought around the $27 to $29 range, and it went down to $20. And it scared me. I'm like, man, what the heck? What am I doing wrong? Is that's usually the new person's thought. What am I doing wrong? What did I do wrong? Well, yeah, I really wasn't doing anything wrong, because at the time Winnebago was undervalued. Even though it went from 27 down to 20, I should have kept on buying and ignored the news. Ignored the, oh, we're going to have a recession soon, because that never happened. You know, people aren't going to want to buy RVs, and that didn't happen. But unfortunately, I was here at about, 27, 28 bucks, and we got into January and February, and it popped up to 33, and I was like, I still kept hearing these negative news reports, and I listened, and so I sold out. I made $6 a share or something like that. But if I would have just stuck with what I thought was a good company trading at a cheap valuation and continued to buy, it went from 27 to 55. That's double. Look at that. 1 year, 86.26%. Yeah. So almost double from what I bought them at. So, what's the point? Now they're overvalued. PE ratio of 17.14. Now I wouldn't touch them at all. If they ever got back down into this range, I'd probably buy them again, because that's how much I like the company. And I think they're pretty healthy. Despite the, recessionary fears and it being a cyclical company, whatnot. So what's that? The lesson is, think long term. Trust what your research is. Don't get shooken out by noise, because there's always going to be negative news. It doesn't matter if it's an up market, a down market. If it's a down market, that's always negative news. If it's an up market, they're anticipating negative news, and they're telling you that it's never going to end. And if it's a down market, they're telling you, oh, it's going to keep on going. And so you have to make the decision to stick with the stocks that you choose if you're comfortable with them. And if you can't do it, if you can't get through that, I finally got through that. But if you can't, if you find yourself selling out off a little news here and there, you might as well buy an index fund or an ETF and forget single stocks. And, I've recently sold out all of my index funds and went to all single stocks, because now I'm comfortable with what I'm doing. My portfolio's I'm not satisfied with it. There's some things I'd like to tweak, change, swap out, etc. But I'm a lot more comfortable participating in the stock market now than I was when I first started. So, keep learning, invest for the long term, trust your input, ignore news, ignore short-term news. Long-term news you could probably pay attention to, like if Winnebago came out and said this year we're gonna see a decline. Well, trust that, because they're the ones running the company. Don't trust some Joe Blow article that says, chances are we're gonna have a hit and these sectors are gonna suffer. Don't trust that. Trust more of the what the company's saying. If they're quality leaders, they're gonna mostly shoot you straight. Some of them do BS a lot, but mostly they're gonna tell you what they can and cannot do. Anyway, I hope this helps, guys. You new guys that are worried about the fluctuations of the market, and stay the course. Buy dips on quality companies, and happy investing. All right, guys, we'll talk to you later. Thanks. Bye-bye.